There's a lie at the heart of modern finance, a dangerous and expensive falsehood, whispered in the halls of business schools and shouted from the screens of financial news networks. It's a lie so pervasive that it forms the foundation of nearly every stock analysis you'll ever encounter. The lie is this: that a company can be understood by numbers alone. That if you can master the language of price-to-earnings ratios, debt-to-equity, and discounted cash flow, you can unlock the secrets to wealth. But the truth, the secret that separates the greatest investors from the merely good ones, is that the most important numbers never appear on a balance sheet. The most powerful asset a company possesses is never listed in its 10K filing, and the most catastrophic liability can be completely invisible to traditional stock analysis. Warren Buffett, the man who built a fortune of over $100 billion from the crumbling textile mills of Berkshire Hathaway, didn't do it by being a better human calculator. He did it by mastering the art of reading the invisible. He learned to assess the one thing that truly drives long-term success or guarantees spectacular failure: a company's culture. This isn't about office perks, team-building exercises, or feel-good mission statements. This is about the deep, underlying operating system of a business. It's the collection of shared habits, beliefs, and assumptions that dictate how people behave when the CEO isn't in the room. It determines whether a company innovates or stagnates, whether it delights customers or exploits them, whether it creates lasting value or simply burns through capital. Investing in a company without understanding its culture is like buying a beautiful, powerful car without ever looking at the engine. It might look great on the surface, but if the engine is corroded and leaking oil, you're headed for a breakdown. The costly market mistake this understanding prevents is catastrophic. It stops you from pouring your hard-earned capital into a business that is quietly rotting from the inside, a company plagued by bureaucracy, infighting, and a lack of purpose that stifles innovation and drives its most talented people to the exits. The financial transformation that awaits you is profound. By the end of this journey, you will have a framework, a new lens through which to view every potential investment. You will learn to look beyond the spreadsheet and assess the intangible, human element of a business, giving you a powerful edge in identifying the healthy, thriving organizations that are built to win for decades. This isn't just another stock-picking tip. This is a fundamental shift in your investment strategy, a secret weapon in your arsenal for achieving true financial education and lasting portfolio growth. This is how you spot a billion-dollar culture. Our first exploration into this hidden world begins with the single most important cultural trait Buffett looks for, the bedrock upon which all other virtues are built. It's the idea of the owner-operator mindset, the profound difference between a culture led by stewards and one led by mercenaries. To understand this, we must travel back in time, not to a glittering Wall Street boardroom, but to a dusty, crowded furniture store in Omaha, Nebraska, and meet a woman who could barely read or write English, but who could teach a masterclass in business to any Ivy League CEO. Her name was Rose Blumkin, but to the world, she was simply Mrs. B. Her story is not just a foundational anecdote, it is the very embodiment of the integrity of leadership that forms the core of a winning company culture. Rose Blumkin fled Russia in 1917, escaping the pogroms with her husband and settling in America. She arrived with nothing but the tag around her neck that read, Fort Dodge, Iowa. She couldn't speak the language, but she possessed an energy that could power a small city. After settling in Omaha, she noticed the exorbitant prices the local furniture stores were charging. She saw an opportunity not just for profit, but for fairness. In 1937, with a loan of $500, she started the Nebraska Furniture Mart in the basement of her husband's pawn shop. Her business philosophy was brutally simple: sell cheap and tell the truth. She wasn't just in the business of selling furniture. She was in the business of building lifelong trust with her customers. She worked 18-hour days, 7 days a week. She was a fanatical negotiator, buying in bulk, paying in cash, and passing the savings directly to her customers. Her competitors, the carpet cowboys as she called them, hated her. They tried to put her out of business, pressuring manufacturers not to sell to her. But Mrs. B was relentless. She would travel to other cities, buy from other dealers, and truck the furniture back to Omaha herself, always ensuring she could undercut the competition. Her store became a local legend, a testament to pure, unadulterated entrepreneurial drive. By the 1980s, the Nebraska Furniture Mart was the single largest home furnishing store in the entire United States, generating hundreds of millions of dollars in annual sales, all from that one location in Omaha. And that's when she caught the attention of her neighbor, Warren Buffett. Buffett had watched Mrs. B's empire grow for decades. He admired not just her success, but the great tattoo she achieved it. He saw a business that was her life's work, an extension of her very identity. In 1983, Buffett decided he wanted to buy the company. He didn't send a team of suits from a private equity firm. He didn't initiate a hostile takeover. He went to see Mrs. B himself. He asked her how much she wanted for the business. She, being Mrs. B, named a price. Buffett didn't haggle. He didn't ask for armies of accountants to perform months of due diligence. He knew the numbers were real because he knew she was real. The deal for control of the company, a transaction worth around $60 million, was sealed not with a 100-page legal document, but with a simple 2-page contract and a handshake. Buffett's reasoning was simple. We gave Mrs. B a check for $55 million, and she gave us her word. That's all we needed. He was buying the culture she had built, a culture of fanatical customer service, relentless cost control, and absolute integrity. He was buying Mrs. B. The story, however, doesn't end there. As part of the deal, Mrs. B and her family would continue to run the business with complete autonomy. But a few years later, at the age of 95, her family forced her into retirement. For a woman whose entire identity was the store, this was a death sentence. So what did she do? She came out of retirement, crossed the street, and opened a rival store called Mrs. B's Clearance and Factory Outlet. She immediately started competing with the very business she had sold to Buffett, and she started winning. She was taking so much business from the Nebraska Furniture Mart that Buffett had no choice but to acquire her new store as well. He famously joked about the mistake of letting a 95-year-old woman with the competitive instincts of a shark retire. She continued to work, zipping around the store on her electric scooter, negotiating deals and berating suppliers, until she was 103 years old. She passed away at 104, having worked almost every single day of her adult life. Mrs. B was the ultimate owner-operator. The business wasn't a job, it was her child. Her personal reputation was on the line, with every sofa sold. This is the culture Buffett seeks to acquire. He isn't just buying assets, he is buying a legacy of obsession, a culture where the leadership thinks and acts like a fanatical owner, not a transient manager. This is the starting point for any serious business analysis. The story of Mrs. B is a powerful illustration of a deep psychological principle that governs human behavior in organizations, the principal-agent problem. This concept, born from economics but rooted in psychology, is one of the most destructive forces in modern capitalism, and understanding it is crucial for any investor practicing advanced stock analysis. The principal is the owner of an asset, in our case, the shareholders of a company. The agent is the person hired to manage that asset, the CEO and their executive team. The problem arises because the interests of the agent are not always aligned with the interests of the principal. The shareholder, principal, wants long-term sustainable growth in the intrinsic value of the business. The hired CEO agent, on the other hand, might have very different goals. They might want a bigger salary, a more prestigious title, a larger corporate jet, or the ego boost that comes from running a larger, more complex empire, even if that empire is less profitable. This divergence of interest creates what are known as agency costs, the subtle and not so subtle ways that shareholder value is destroyed by managers acting in their own self-interest. This misalignment is supercharged by several powerful cognitive biases. First, there's the overconfidence bias. A CEO who has experienced some success might believe they have the Midas touch, leading them to pursue risky, value-destroying acquisitions outside of their expertise. simply to expand their domain. They genuinely believe they can manage any business, a classic symptom of executive hubris. Then there's the incentive-caused bias, which Charlie Munger calls one of the most powerful forces in the universe. If a CEO's compensation is tied to short-term metrics like quarterly earnings per share or the company's stock price, they will move heaven and earth to manipulate those numbers, even if it means sacrificing the long-term health of the company. They might cut back on crucial research and development, use accounting tricks to smooth earnings, or engage in reckless share buybacks at inflated prices, all to trigger a multi-million-dollar bonus. Their financial incentive is directly opposed to the long-term wealth management of the actual owners. The owner-operator mindset, the culture embodied by Mrs. B, is the ultimate antidote to the principal-agent problem. In an owner-led business, the principal and the agent are the same person. The CEO's personal wealth, often the vast majority of it, is tied up in the stock of the company. Their family name is on the door. Their personal reputation is inextricably linked to the quality of the product and the satisfaction of the customer. The psychological force at play here is the commitment and consistency bias. For a founder or a long-term owner-operator, the company is not just a line on their resume, it is a core part of their identity. They are psychologically committed to its success in a way a hired manager can never be. They feel the pain of a bad quarter in their own bank account and their own heart. They think in terms of decades, not quarters, because they are building a legacy, not just padding their next compensation package. When Buffett bought Nebraska Furniture Mart, he wasn't just buying inventory and a building, he was buying an alignment of interests that was so perfect, it eliminated agency costs entirely. He was investing in a culture where the person in charge was psychologically incapable of not acting in the best interests of the business because the interests of the business were her interests. This is the CEO mindset that creates staggering long-term capital gains. So how can you, as an outside investor, apply this principle to your own stock picking? How can you identify a culture of ownership integrity from afar? You need a practical mental model, a blueprint you can use to systematically assess the leadership of any company. Let's call it the Owner's Integrity Scorecard. It's a 4-part qualitative analysis tool that helps you look past the polished corporate messaging and see the true character of the management. First, become a student of shareholder letters. Go to the company's investor relations website and read the annual letter to shareholders for the past 10 years. Don't just skim them. Print them out, get a highlighter, and read them like a detective searching for clues. Are the letters clear, candid, and written in plain English, or are they filled with impenetrable corporate jargon and buzzwords? A leader who thinks like an owner communicates like a partner, not like a public relations machine. Look for a consistent message over the years. Do they talk about the same core business principles year after year? Most importantly, how do they discuss mistakes? A hired gun CEO will gloss over failures, blame the economy, or use convoluted language to obscure bad results. An owner-operator like Buffett in his own letters will address mistakes head-on, take responsibility, and explain what they learned. Candor about failure is one of the most powerful indicators of leadership integrity. Second, dissect the executive compensation plan. This is usually buried in the company's proxy statement, and it's required reading for any serious investor. You need to ask one simple question. Does this plan encourage the CEO to act like an owner or a gambler? Look at the metrics used for bonuses. Are they tied to fuzzy, easily manipulated numbers like adjusted EBITDA? Or are they linked to long-term, difficult-to-gain metrics like growth in per-share intrinsic value or return on invested capital? Look at the stock options. Are they granted at the current market price, or do they have strike prices well above the current price? Meaning, the executive only gets paid if they create substantial real value for shareholders. Beware of compensation plans that look like a heads-I-win, tails-you-lose proposition for the CEO, where they get rich even if the company's performance is mediocre. A culture of ownership ties rewards directly to the creation of long-term shareholder value. Third, investigate insider ownership. This is a straightforward but incredibly powerful data point. Do the executives and directors have a significant portion of their own net worth invested in the company's stock? In other words, are they eating their own cooking? You can find this information in regulatory filings. A CEO who owns millions of shares they bought with their own money has a completely different set of motivations than a CEO who was simply granted a large block of options. High insider ownership aligns interests perfectly. They feel the pain of a declining stock price just as acutely as you do. Conversely, a pattern of high-level executives consistently selling off their shares, even for seemingly legitimate reasons, can be a major red flag about their long-term belief in the business. Fourth and finally, research the leader's life story. This is a crucial part of leadership analysis that goes beyond the numbers. Has the CEO been with the company for decades, working their way up through the ranks? Or are they a recent hire from outside the industry, a so-called professional manager? Buffett has often expressed his preference for promoting from within, and for leaders who have a deep, almost obsessive-compulsive understanding of their specific business. Look into their past. Have they successfully built and scaled businesses before, or is their resume a series of short stints at different corporations? You're looking for evidence of a builder's mindset, a history of long-term commitment, not a mercenary's track record of job hopping in search of a bigger paycheck. This scorecard isn't foolproof, but it provides a robust framework for assessing the human element of leadership, the cultural foundation that will either support or undermine any investment you make. To truly appreciate the power of the owner-operator culture, we must examine its opposite. We must walk the path of the 99%, the path taken by countless investors who are seduced by superficial metrics and charismatic but self-serving leaders. This is the path of investing in the hired gun CEO, the antithesis of the owner-operator. The hired gun is a master of appearances. They have a polished MBA, a silver tongue for charming Wall Street analysts, and a knack for delivering a smooth quarterly earnings call. Their primary focus, however, is not on the long-term health of the business, but on the short-term performance of its stock price, because that is what determines the size of their bonus. Their culture is not one of building, but of financial engineering. The perfect and most tragic example of this destructive cultural archetype is the disastrous AOL-Time Warner merger of 2000. At the helm were two quintessential hired guns, Steve Case of AOL and Gerald Levin of Time Warner. Case was the champion of the new economy, a company with a soaring stock price but flimsy underlying business fundamentals. Levin was the head of an old media giant, feeling immense pressure from Wall Street to do something to get his company's stock moving. Neither man was a founder in the mold of Mrs. B. They were professional managers, driven by ego, market pressure, and a desire to create the biggest media company in the world. The culture they fostered was one of deal-making and empire-building, not operational excellence or customer satisfaction. The merger was sold to investors on a wave of hype about synergies, that magical, mythical force that supposedly makes 1 + 1 = 3. They promised a future where Time Warner's content would flow seamlessly through AOL's internet pipes, creating an unstoppable digital media juggernaut. But the reality was a catastrophic clash of cultures. AOL's culture was aggressive, sales-driven, and arrogant, a reflection of its dot-com bubble origins. Time Warner was a collection of proud, siloed media fiefdoms, HBO, Warner Brothers, Time Inc., each with its own history and identity. They viewed the AOL executives as unsophisticated upstarts. The promised synergies never materialized. Instead, the combined company was plagued by infighting, turf wars, and a complete lack of a coherent strategy. The focus shifted from serving customers to navigating the treacherous internal political landscape. Talented executives fled the company in droves. The culture wasn't just unproductive, it was toxic. It actively destroyed the value that had existed in the separate companies. Within 2 years, the dot-com bubble had burst. AOL's business model was exposed as a house of cards, and the company was forced to take a goodwill write-down of nearly $100 billion, at the time the largest corporate loss in U.S. history. Shareholder value was annihilated, Investors who had bought into the hype, who had listened to the hired gun CEOs and their promises of synergy, lost everything. They had invested in a story, not a culture. They had looked at the combined company's pro forma financials and ignored the screamingly obvious cultural incompatibility. This is the fate that awaits those who ignore the integrity and mindset of leadership. It's a costly lesson in the dangers of prioritizing deal-making over the hard, unglamorous work of building a sustainable business. The financial connection between an owner-operator culture and superior returns is not theoretical. It is direct, tangible, and measurable on the financial statements of a company. When you find a business guided by the hand of a true owner, you will see a distinct pattern of financial excellence that stands in stark contrast to its manager-led peers. This is where qualitative analysis of culture meets quantitative proof of performance, the key to a truly holistic investment strategy. First, look at the expense lines, specifically selling, general, and administrative expenses, or SG&A. In a company run by a hired gun, this line item is often bloated. It's filled with the costs of a lavish corporate headquarters, a fleet of private jets, excessive layers of middle management, and expensive consultants. These are the trappings of empire. An owner-operator, thinking with the frugality of someone spending their own money, runs a much leaner ship. They see excessive overhead not as a status symbol, but as a direct theft from the bottom line. Think of Mrs. B working out of a simple, no-frills showroom, or Buffett himself, still operating out of the same modest office in Omaha for over 60 years. This cultural commitment to efficiency translates directly into higher operating margins. For every dollar of revenue, more of it falls to the profit line, compounding value for shareholders year after year. Second, analyze the company's return on invested capital, or ROIC. This metric measures how efficiently a company is using its capital to generate profits. It is the ultimate report card for a CEO's capital allocation skills. A hired gun CEO, often driven by ego and the desire to run a larger company, is prone to making large, flashy acquisitions that they often overpay for. This diversification adds a huge amount of capital to the balance sheet in the form of goodwill, but often fails to generate a commensurate return, thus depressing the company's ROIC. An owner-operator, on the other hand, is allergic to dumb acquisitions. They treat shareholder capital as sacred. They will only deploy it when they are highly confident that the return will exceed their cost of capital. They are perfectly happy to sit on cash and wait for the right opportunity, rather than chasing growth for growth's sake. This discipline results in a consistently high and stable ROIC, a clear signal that the company's culture is focused on creating genuine economic value, not just getting bigger. Finally, look at the balance sheet and the history of value creation. An owner-led culture is focused on the long-term compounding growth of per-share intrinsic value. This means they are more likely to use excess cash to opportunistically buy back their own shares when they are trading below intrinsic value, a tax-efficient way to reward long-term owners. A manager-led culture, obsessed with quarterly numbers, might buy back shares at any price, simply to prop up the earnings per share figure and trigger their bonus. The owner-operator is building wealth for the long haul. The hired gun is trying to hit a quarterly target. The evidence of this difference is written in the long-term stock chart. Companies with strong owner-operator cultures often exhibit a steady, relentless upward march in value over decades, creating life-changing capital gains for their investors. The companies run by hired guns often show periods of frantic activity and a soaring stock price, followed by a dramatic and painful collapse when the unsustainable strategies inevitably unravel. The choice for the investor is clear. To achieve superior portfolio growth, you must learn to invest not just in businesses, but in the rare and powerful cultures of ownership that guide them. The second great pillar of a billion-dollar culture, a concept intertwined with the first but distinct in its application, is the relentless adherence to a circle of competence. For Buffett, this is not just a personal investing rule. It is a cultural filter he uses to identify businesses that are built to last. A company that understands its circle of competence has a culture of deep expertise, intellectual honesty, and disciplined focus. It resists the siren song of endless expansion and instead concentrates its energy on dominating its specific niche. This cultural focus is a powerful defense against the corporate graveyards filled with companies that tried to be everything to everyone and ended up being nothing to anyone. To truly grasp this, we must journey to the sunny state of California and unwrap the sweet secret of one of Buffett's most successful and instructive investments, See's Candies. In 1972, Warren Buffett and Charlie Munger, through their holding company Blue Chip Stamps, had the opportunity to purchase See's Candies. See's was a beloved West Coast institution, a family-owned business started by Mary See in 1921. It had a fanatically loyal customer base, a reputation for quality, and a strong brand name. The asking price was $30 million. Buffett's partner, Rick Guerin, thought the price was too high. The company had tangible assets, factories, inventory, stores, worth only about $8 million. The remaining $22 million was for the intangible asset of the brand, the goodwill. At the time, Buffett was still heavily influenced by his mentor, Ben Graham, the father of value investing, who taught him to buy businesses for less than their net working capital, the classic cigar butt approach. Paying a huge premium for an intangible brand was a major departure. But Charlie Munger pushed him. Munger understood that the brand, the customer loyalty, the nostalgic connection people had to that box of chocolates was a far more valuable asset than any factory or machine. It was a durable competitive advantage that allowed See's to consistently raise its prices without losing customers. They bought the company for $25 million. What they did next is a masterclass in respecting a circle of competence. Any typical corporate chieftain or private equity firm would have seen See's as a platform for massive, immediate growth. They would have drafted plans to roll out thousands of new stores across the entire United States, to expand into international markets, to leverage the brand into new product categories like ice cream or baked goods. It's the standard MBA playbook: grow at all costs. But Buffett and Munger understood that the magic of See's was regional and deeply tied to its California heritage. A massive, debt-fueled expansion would risk diluting the brand's mystique and destroying the very quality that made it special. Instead of pouring every dollar of profit back into growing the candy business, they adopted a different strategy. They maintained the brand's quality obsessively. They raised prices every year, a little bit at a time, and found that customers, who associated See's with special occasions and heartfelt gifts, barely noticed. The business became a cash flow machine, a gusher, as Buffett would call it. It generated enormous amounts of capital without requiring much new investment. And what did they do with that capital? They didn't senselessly reinvest it in 1,000 new candy stores. They pulled it out of See's and used that river of cash to buy other wonderful businesses like the Washington Post, Geico, and Coca-Cola. The culture they nurtured at See's was one of operational excellence and brand preservation within its defined circle of competence. They didn't ask the managers of See's to become experts in global logistics or international franchising. They asked them to continue making delicious candy and delighting their existing customers. They understood that the company's competence was in high-quality chocolate and regional brand management, not in rapid, global expansion. This discipline, this refusal to stray from what they knew and did best, is the cultural essence of the circle of competence. See's Candies taught Buffett one of the most important lessons of his career. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And a key component of a wonderful company is a culture that knows its own boundaries and has the wisdom not to cross them. The corporate tendency to stray beyond a company's core expertise is a predictable and destructive pattern, and it's driven by a powerful psychological flaw known as the Dunning-Kruger effect. This cognitive bias, identified by psychologists David Dunning and Justin Kruger, describes a phenomenon where people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. This psychological trap is a breeding ground for disastrous corporate strategy. A CEO and an executive team that have been successful in one specific industry, say manufacturing widgets, can begin to believe they are simply brilliant business people in general. Their success in a domain they understand deeply creates an illusion of universal mastery. This is the curse of competence. They look at a completely unrelated industry, software for example, or media, and think, how hard can it be? We're smart people, we'll figure it out. They are standing on the peak of Mount Stupid, as the Dunning-Kruger graph famously illustrates, utterly blind to the vast landscape of their own ignorance. This cognitive bias is what fuels the value-destroying activity that Buffett colorfully calls diversification, the process of expanding into new areas that not only fail to add value but actively harm the core business. When a company strays from its circle of competence, it's not just entering a field where it lacks expertise, it's often entering a field where it is competing against companies for whom that field is their circle of competence. The invading company's management lacks the nuanced understanding, the industry relationships, and the intuitive feel for the business that the incumbents possess. They are playing a game where the rules are unknown and their opponents have been playing it their entire lives. This almost always leads to overpaying for acquisitions, fumbling the integration, and ultimately failing to compete effectively. The corporate culture becomes distracted. Management attention, the most precious and finite resource a company has, is diverted from nurturing the core business that generates all the cash and is instead wasted on trying to salvage the failing new venture. The company loses its focus, its identity, and eventually, its profitability. A corporate culture that respects its circle of competence is a culture that has institutionalized intellectual humility. It has created processes and a shared language for saying, we don't know enough to play in that game, and that's okay. This cultural discipline is the only effective vaccine against the Dunning-Kruger effect and the siren call of diversification. It is a key marker of a management team dedicated to sustainable, long-term investing of company resources. To operationalize this principle in your own investment process, you need a mental model for evaluating a company's cultural commitment to its circle of competence. Let's call this framework the competence map. It's a three-step business analysis technique designed to determine if a company is a focused master of its craft or a distracted dabbler destined for mediocrity. Step 1 is to define the core. Before you can tell if a company is straying, you must have a crystal clear definition of what its core competence actually is. This requires more than just reading the About Us section on their website. You need to dig into the financials and answer a fundamental question. What is the one thing this company does that generates the vast majority of its cash flow and profit? Is it a low-cost manufacturing process, a beloved consumer brand, a powerful network effect, a proprietary technology? You must be able to articulate this core competence in a single, simple sentence. For See's Candies, it's selling premium boxed chocolates through a regional network of stores, supported by a powerful, nostalgic brand. If you cannot clearly define the core, that itself is a red flag. It may be a sign that the company itself has lost its focus. Step 2 is to chart the periphery. Once you have a firm grasp of the core, you need to systematically analyze every other business line, every new product launch, and every acquisition the company has made over the past 5 to 10 years. For each one, you must ask, is this a logical and adjacent extension of the core competence, or is it a wild leap into an unrelated field? For example, if a company with a core competence in running successful coffee shops acquires a small bakery chain, that's a logical adjacency. They are leveraging their expertise in retail site selection, supply chain management, and customer service. However, if that same coffee company decides to acquire a social media startup, that is a massive red flag. It's a clear departure from their circle of competence. You are looking for a pattern. Does the company's expansion history look like a series of concentric circles, moving carefully outward from a strong center, or does it look like a shotgun blast, with random bets scattered across the corporate landscape? Step 3 is to listen for the language. This is a subtle but powerful qualitative technique. Pay close attention to how management talks about their business in annual reports, investor presentations, and earnings calls. When they discuss their core business, do they speak with deep, granular, almost obsessive detail? Do they use the specific language of their industry and their customers? This is the sound of true competence. Now listen to how they describe their new ventures and acquisitions. Do they resort to vague, generic business jargon like synergy, platform, ecosystem, and digital transformation? This is often the language used to mask a lack of deep understanding. When a CEO can't explain a new business in simple, clear terms, it's often because they don't truly understand it themselves. They are venturing outside their circle, and they are using buzzwords as a smokescreen. The competence map provides a structured way to assess a company's strategic focus, a crucial element of finding growth stocks that are built for sustainable success, not just a temporary flash of excitement. The path of the 99% is littered with the wreckage of companies that ignored this fundamental principle. To understand the antithesis of a competence-focused culture, we must examine the synergy-chasing conglomerate, a corporate structure that was once in vogue but has since been exposed as a deeply flawed model for value creation. The poster child for this destructive cultural model was Tyco International, under the leadership of CEO Dennis Kozlowski. In the late 1990s and early 2000s, Kozlowski transformed Tyco from a staid industrial manufacturer into a sprawling global conglomerate through a breathtakingly aggressive acquisition spree. The culture at Tyco was not about operational excellence. It was about doing deals. The company was a machine designed for one purpose: to acquire other companies, strip out costs, and use accounting gimmicks to meet Wall Street's quarterly earnings expectations. Kozlowski bought hundreds of companies in completely unrelated industries. Tyco was involved in everything from home security systems, ADT, and electronic components, to undersea fiber optic cable and medical supplies. There was no unifying strategic logic, no semblance of a circle of competence. The only thing these businesses had in common was that they were targets in Kozlowski's relentless campaign of acquisition. The justification for this strategy was, as always, synergy. The idea was that by combining all these disparate businesses under one corporate umbrella, they could share administrative costs, cross-sell products, and achieve a level of efficiency that they couldn't on their own. But the synergies, much like in the AOL Time Warner debacle, were a fantasy. The reality was a complex, bloated, and utterly incoherent mess. The corporate headquarters couldn't possibly have a deep understanding of the dozens of different industries in which it was operating. The culture was not one of building great businesses, but of financial manipulation and personal enrichment for the top executives. The inevitable collapse came in 2002 when Kozlowski's excesses and the company's questionable accounting practices came to light. The details were shocking: multi-million-dollar parties funded by the company, interest-free loans to executives that were later forgiven, and a level of personal greed that became a symbol of corporate corruption. The stock price, which had been a Wall Street darling, collapsed by over 80%, wiping out tens of billions of dollars in shareholder value. Tyco was a company that had completely abandoned the idea of a circle of competence. Its culture celebrated breadth over depth, deal-making over operating, and financial engineering over genuine value creation. It stands as a stark and powerful warning. A company that tries to be an expert in everything will ultimately prove to be an expert in nothing, least of all the responsible management of shareholder capital. The path of diversification leads not to synergy, but to disaster. The direct financial connection between a culture of focused competence and long-term portfolio growth is undeniable. This is where the intangible virtue of focus translates into hard, quantifiable financial results that you can track over time. A company that stays within its circle of competence exhibits a financial profile that is cleaner, stronger, and more predictable than that of a sprawling, unfocused conglomerate. First, a focused culture leads to higher and more stable profit margins. When a company is a true expert in its field, it develops efficiencies and insights that its less focused competitors cannot match. It understands its customers better, its supply chain is more optimized, and its marketing is more effective. This operational excellence allows it to command better pricing, control its costs more effectively, and ultimately generate higher margins on its sales. A company that is constantly venturing into new fields, by contrast, is always on the steep part of the learning curve. It makes rookie mistakes, faces unexpected costs, and struggles to compete with entrenched incumbents. This is reflected in volatile and often declining profit margins. As an investor, tracking a company's gross and operating margins over a 10-year period is a powerful way to financially quantify its cultural focus. A steady or rising margin trend is evidence of a business that is deepening its expertise, while a volatile or declining trend can be a warning sign of a company that has lost its way. Second, a disciplined approach to staying within a circle of competence creates a much cleaner and more trustworthy balance sheet. The synergy-chasing conglomerate, like Tyco, builds its balance sheet through acquisitions. This results in a massive line item called goodwill, which represents the premium paid for an acquired company over the value of its tangible assets. When those acquisitions inevitably fail to live up to their hype, the company is forced to take, quote, goodwill impairments, which are massive write-downs that publicly acknowledge they overpaid. These write-downs are a direct destruction of shareholder capital. A focused company, on the other hand, tends to grow more organically. Its balance sheet is composed primarily of tangible, productive assets that it has built or bought at rational prices. It will have far less goodwill, and is therefore far less likely to suffer from these value-destroying impairments. A clean balance sheet, with low goodwill relative to total assets, is often the financial fingerprint of a focused and disciplined corporate culture. This is a crucial aspect of management assessment for any investor committed to long-term investing. Finally, a culture of focus generates more predictable and reliable cash flows. A business that deeply understands its market can better anticipate trends, manage inventory, and forecast its financial performance. This predictability is a huge advantage, not just for the company's internal planning, but for its investors as well. It allows the company to make more intelligent capital allocation decisions and provides a more stable foundation for valuation. A diversified conglomerate, juggling businesses in multiple unrelated industries, is subject to a wider range of economic and competitive forces, making its future cash flows far more difficult to predict. This uncertainty increases the risk for investors and often leads to a lower valuation multiple from the market. In the end, the circle of competence is not just a quaint philosophical idea, it is a rigorous and profitable business strategy. The evidence is written in the numbers. Higher margins, cleaner balance sheets, and more predictable cash flows are the tangible financial rewards of a culture that has the wisdom to know what it knows and the discipline to stick to it. Moving forward, we arrive at the third essential pillar of a billion-dollar culture, the moat mentality. An economic moat, a term popularized by Buffett, refers to a sustainable competitive advantage that protects a business from its rivals, much like a moat protects a castle. But a moat is not just a static feature on a corporate landscape. A truly great company has a culture that is obsessively focused on constantly defending and widening that moat. It is a culture of perpetual paranoia and relentless improvement, an organization that understands that competitive advantages are not permanent unless they are actively maintained. To understand this warrior culture, we must turn our attention to one of the most powerful brands in human history, a company whose moat is so wide and deep, it seems almost mythical, the Coca-Cola Company. Buffett's investment in Coca-Cola, which began in 1988, is legendary. He invested over $1 billion, representing a huge portion of Berkshire's portfolio at the time. What he saw in Coke was not just a successful beverage company, but a business with one of the most formidable economic moats ever constructed. The moat had several components. First was its universally recognized brand, an intangible asset built over a century of relentless marketing. The Coca-Cola name and logo are among the most valuable pieces of intellectual property on the planet. But the moat was deeper than just branding. It also consisted of a global distribution network of bottlers and retailers that was practically impossible for a competitor to replicate. Coke had achieved what its legendary leader Robert Woodruff had set out to do, to be within an arm's reach of desire for every consumer on Earth. But Buffett's analysis went beyond these static advantages. He saw a corporate culture that was fanatically dedicated to defending and expanding this moat. The cola wars with Pepsi were not just a marketing gimmick. They were a reflection of a deeply ingrained cultural mindset. Coke's culture was one of a benevolent global conqueror. Every decision, from advertising campaigns to bottler negotiations to the placement of a new vending machine, was made with one question in mind: does this strengthen our moat? The company was obsessed with share of stomach, the concept that it was competing not just with other sodas, but with every other beverage a person could possibly drink, including milk, coffee, and water. This expansive view of their competitive landscape fostered a culture that could never rest on its laurels. It had to constantly innovate, market, and distribute its product more effectively than anyone else. The culture was one of perpetual defense. When Pepsi launched the Pepsi Challenge, a blind taste test that showed many consumers preferred the taste of Pepsi, Coca-Cola didn't ignore the threat. In fact, their paranoia led them to one of the biggest marketing blunders in history, the launch of New Coke in 1985. While the product itself was a failure, the episode revealed the depth of the company's cultural commitment to defending its leadership position. They were willing to tamper with a 100-year-old sacred formula in their obsessive quest to fend off their rival. And when the public outcry forced them to bring back Coca-Cola Classic, the brand emerged even stronger, with its emotional connection to consumers reaffirmed. Buffett saw this. He saw a company whose very identity was intertwined with its competitive dominance. The employees at Coca-Cola didn't just work for a beverage company. They were soldiers in an army, tasked with defending the castle walls every single day. This moat mentality is the cultural engine that turns a good business with a competitive advantage into a great business that can compound value for decades. The psychological principle that underpins the moat mentality is a powerful concept borrowed from evolutionary biology known as the Red Queen effect. The name comes from Lewis Carroll's Through the Looking Glass, where the Red Queen tells Alice, "Now, here, you see, it takes all the running you can do to keep in the same place." In biology, this refers to the coevolutionary arms race between species. A predator evolves to become faster, so the prey must also evolve to become faster, just to maintain the same rate of survival. The same is true in the world of business. The competitive landscape is not static. Your rivals are constantly innovating, your customers' tastes are changing, and new technologies are emerging that could render your business obsolete. A company that stands still, that simply rests on its existing moat, will inevitably find that moat being filled in by the relentless march of competition. A culture with a moat mentality has internalized the Red Queen effect. It operates with a healthy dose of paranoia, assuming that its competitors are smart, well-funded, and working tirelessly to steal its customers. This creates a powerful and productive sense of urgency. This paranoia is also psychologically linked to the concept of loss aversion, a cornerstone of behavioral economics discovered by Daniel Kahneman and Amos Tversky. Loss aversion describes our tendency to feel the pain of a loss about twice as strongly as we feel the pleasure of an equivalent gain. For a company with a strong culture, the thought of losing its competitive advantage, of seeing its moat shrink, is a far more powerful motivator than the prospect of a small, incremental gain in market share. This fear of loss drives the company to invest heavily in things that strengthen the moat: research and development, brand advertising, customer service, even if these investments don't have an immediate, obvious payoff on the next quarterly earnings report. The culture is structured around preventing the catastrophic pain of losing its dominance. It fosters a defensive crouch, a state of constant vigilance that is essential for long-term survival and success. This is a CEO mindset that prioritizes resilience over short-term glory, a key trait for any investment designed for portfolio growth. So how can you, as an investor, determine if a company has a culture with a true moat mentality? You need a practical framework for looking beyond the surface-level descriptions of competitive advantage. Let's call this mental model the moat deepening audit. It's a three-part qualitative and quantitative process for assessing whether a company is actively widening its moat or passively letting it fill with sand. First, you must identify the moat type and its source. A moat isn't a generic concept, it comes in several distinct flavors. Is it a powerful brand, like Coca-Cola? Is it a network effect, where the product becomes more valuable as more people use it, like Facebook or Visa? Is it a low-cost production advantage, like Geico's direct-to-consumer insurance model? Is it high switching costs, where it is expensive or difficult for a customer to move to a competitor, like a company's enterprise software? Or is it an intangible asset, like a patent or a regulatory license? You must first be able to clearly identify the primary source of the company's competitive advantage. This is the foundation of your analysis. Second, you must follow the money to find the capital allocation story. A company's true priorities are revealed not by what its CEO says, but by where it invests its capital. Dig into the company's financial statements, specifically the statement of cash flows. Where is the company's free cash flow going? Is it being reinvested heavily in research and development to improve the product and stay ahead of the technology curve? This widens a technology-based moat. Is it being poured into advertising and marketing to strengthen the brand and build a deeper emotional connection with customers? This widens a brand-based moat. Or is the company spending very little on R&D and marketing, and instead returning most of its cash to shareholders through dividends and buybacks? This might be a sign of a mature harvesting moat, but it could also be a red flag that management is failing to reinvest in defending its competitive position. The capital allocation story tells you whether the culture is focused on growth and defense or on managing a gentle decline. Third, you must listen to the customer's voice. The first signs of a shrinking moat almost always appear in the customer experience. Before it ever shows up in the financial statements, a weakening competitive advantage is felt by the people who use the product or service. You must become a detective, scouring the internet for clues. Read online reviews, both positive and negative. Look for trends in customer satisfaction surveys. Read industry trade publications and analyst reports that discuss the company's reputation relative to its competitors. Are customers happy and locked in? Or are they complaining about price increases, poor service, and a lack of innovation? Are they actively looking for alternatives? A rising tide of customer discontent is a 5-alarm fire. It's a clear signal that the company's culture has become complacent and its moat is in serious danger. The moat deepening audit is a powerful tool for any stock analysis, helping you to distinguish between companies that have a temporary advantage and those with a deeply ingrained cultural commitment to long-term dominance. The corporate landscape is a graveyard of companies that failed this audit. To understand the antithesis of the moat mentality, we must look at the, quote, complacent incumbent. The company that once had a powerful moat, but whose culture became arrogant and lazy, leading to its own demise. There is no better example of this than the story of Blockbuster Video. In its heyday in the 1990s and early 2000s, Blockbuster had what appeared to be an impenetrable moat. Its competitive advantage was its vast network of physical retail stores. If you wanted to rent a new movie on a Friday night, Blockbuster was the only game in town. This physical distribution moat gave them immense pricing power, which they used not to delight customers, but to exploit them. The company's business model was heavily reliant on charging exorbitant late fees, a practice that generated huge profits but also created enormous resentment among its customer base. The culture at Blockbuster was one of complacency. The executives believed their retail footprint was an unassailable advantage. They were the incumbent, and they acted like it. So in 2000, when a small startup called Netflix, led by Reed Hastings, approached them with a proposal to partner, Netflix would run Blockbuster's online business. The Blockbuster executives literally laughed them out of the room. They saw Netflix, with its model of mailing DVDs in red envelopes and no late fees, as a niche, insignificant threat. They failed to see that the world was changing and that technology was about to render their physical moat completely obsolete. Blockbuster's culture was focused inward, on optimizing its existing, exploitative business model, rather than outward, on anticipating future customer needs and technological shifts. They failed to invest in a robust online strategy. They were so enamored with the profits from late fees that they were culturally incapable of embracing a more customer-friendly model. The rest, of course, is history. Netflix's subscription model, with its convenience and lack of punitive fees, was a massive hit with consumers. The rise of broadband internet then allowed Netflix to pivot to streaming, making Blockbuster's physical stores not just unnecessary, but a massive liability. Blockbuster tried to launch its own online service, but it was too little, too late. Its culture of retail-based thinking couldn't adapt. The company filed for bankruptcy in 2010. It wasn't killed by Netflix. It committed suicide through its own cultural arrogance and complacency. Blockbuster had a moat, but it lacked a moat mentality. It focused on harvesting its advantage rather than defending and adapting it. It stands as a timeless lesson for every investor. A moat is only as strong as the culture dedicated to maintaining it. The direct financial connection between a moat mentality and superior long-term returns is profound and can be clearly seen in a company's financial statements. A business with a wide and widening moat, supported by a vigilant culture, generates a set of financial figures that are the envy of its competitors and a source of immense wealth for its shareholders. The most direct financial manifestation of a strong moat is sustainable pricing power. A company that provides a unique and desirable product or service, protected from competition, can consistently raise its prices over time without a significant drop in demand. This translates directly into high and stable gross margins. Look at a company like Moody's, the credit rating agency. Its moat is the trusted brand and the fact that its ratings are deeply embedded in the financial system. This allows it to command high prices for its services, resulting in astonishingly high gross margins that have been sustained for decades. As an investor, you can identify a strong moat by analyzing the trend of a company's gross margin. If it is consistently high and stable, or even rising, it's a strong indicator of pricing power and a durable competitive advantage. If the gross margin is volatile and constantly under pressure, it's a sign of intense competition and a weak or non-existent moat. Furthermore, a company with a strong moat culture typically exhibits a very high return on tangible assets. Think about Coca-Cola again. The company's most valuable assets are its brand and its formula, which don't even appear on the balance sheet. The tangible assets, the syrup factories and office buildings, are relatively small compared to the enormous profits the business generates. This means that for every dollar invested in tangible assets, the company produces a huge amount of earnings. This is the financial signature of a business with a powerful intangible moat. Companies stuck in highly competitive industries with no moat, like an airline or a commodity steel producer, require massive investments in tangible assets, airplanes, factories, just to generate a meager profit. Their return on tangible assets is perpetually low. By comparing the return on tangible assets across different companies and industries, you can get a clear quantitative measure of the strength of their economic moats. This is a crucial metric for any investment strategy aimed at identifying the truly exceptional businesses capable of beating the market. Finally, a widening moat fueled by a defensive culture creates a compounding machine. Because the business is so profitable and requires relatively little new capital to sustain itself, it generates a huge amount of free cash flow. This cash can then be reinvested in strengthening the moat even further, or it can be used to buy back shares or invest in other attractive businesses, as Berkshire Hathaway does. This creates a virtuous cycle of value creation. The strong get stronger. A company with a moat is playing offense while its competitors are stuck playing defense. The financial result of this dynamic is a long-term track record of consistent growth in earnings per share and a stock price that compounds at a high rate for many years. The moat mentality isn't just a defensive strategy, it's the ultimate offensive weapon for creating sustainable long-term capital gains and achieving true financial freedom. Our fourth pillar penetrates the very structure of an organization, revealing a cultural principle that seems paradoxical but is, in fact, a source of immense strength and dynamism. This is the principle of decentralized autonomy, a culture of profound trust and radical responsibility. Warren Buffett's management style for the diverse collection of businesses under the Berkshire Hathaway umbrella is famously, almost absurdly, hands-off. He buys great businesses run by great managers, and then, for the most part, he leaves them alone. This is not laziness. It is a deliberate and powerful cultural choice that unleashes entrepreneurial energy and fosters a deep sense of ownership throughout the organization. To witness this principle in its most dramatic form, we must travel to a high-tech factory in the north of Israel and learn the story of the acquisition of Iskar Metalworking. Iskar is one of the world's leading manufacturers of precision carbide metalworking tools, the incredibly hard and sharp instruments used to cut and shape metal in industries from automotive to aerospace. It was founded in 1952 by Stef Wertheimer and built into a global powerhouse by his son, Eitan. The culture at Iskar was one of intense innovation, engineering excellence, and a fanatical obsession with serving their customers. They were known for their brilliant engineers who would work side by side with clients to create custom cutting tools that solved their most difficult manufacturing problems. In 2006, Buffett was given a short, 98-page prospectus about the company. He read it and was immediately intrigued by the business and its dominant market position. He called Eitan Wertheimer. They spoke for a while, and Buffett invited him to Omaha. Wertheimer flew to Nebraska and met with Buffett and Munger for a single afternoon. They talked about the business, its culture, and its future. By the end of the meeting, they had a deal. Berkshire Hathaway would acquire 80% of Iskar for $4 billion. What is most remarkable about this story is what didn't happen. Buffett never sent a team of auditors to crawl over Iskar's books for months. He never hired consultants to analyze the competitive landscape. He never even visited the Iskar factories in Israel before the deal was done. His entire due diligence process consisted of reading one document and having one conversation. Why? Because his analysis was not focused on the numbers, it was focused on the people and the culture they had built. He saw in Eitan Wertheimer a brilliant manager and a passionate owner who was completely devoted to his business. He trusted him implicitly. After the acquisition, Buffett's instructions to Wertheimer were simple. Keep running the business exactly as you have been. Call me if you need me. He imposed no Berkshire bureaucracy, no centralized reporting requirements, no pointless meetings. Iskar continued to operate as an independent, entrepreneurial entity, but now with the permanent capital and backing of Berkshire Hathaway. The result? The business flourished. Under Berkshire's ownership, Iskar continued to innovate and grow, eventually leading Buffett to purchase the remaining 20% of the company for another $2 billion in 2013. The story of Iskar is the ultimate testament to Buffett's belief in a culture of decentralized autonomy. He understood that talent and passion wither under the weight of bureaucracy. The best way to kill a great business is to smother it with layers of corporate oversight. The best way to make it soar is to give its leaders the freedom and responsibility to do what they do best. The immense power of decentralized autonomy is rooted in a fascinating psychological phenomenon known as the Pygmalion effect, also called the Rosenthal effect. This principle, demonstrated in numerous studies, shows that our expectations of others can become self-fulfilling prophecies. If you treat people as if they are intelligent, responsible, and capable, they are far more likely to behave in that way. Conversely, if you treat them with suspicion and micromanage their every move, you will foster a culture of dependency and mediocrity. Buffett's extreme hands-off management style is the ultimate application of the Pygmalion effect at a corporate level. His act of trusting a manager with a multi-billion-dollar business is a powerful signal of his high expectations. It communicates, more effectively than any speech or memo, "I believe in you, I trust your judgment, I expect you to succeed." This profound trust is a massive psychological motivator. It inspires managers to rise to the occasion, to take ownership of their results, and to act with the diligence and creativity of a true entrepreneur. This ties directly to another powerful psychological concept, the locus of control. This refers to the degree to which people believe they have control over the outcomes of events in their lives. People with a strong internal locus of control believe that their own actions determine their rewards and failures. They feel empowered and take responsibility. People with a strong external locus of control believe that their lives are controlled by outside forces, luck, fate, or, in a corporate setting, the decisions made at headquarters. A culture of decentralized autonomy cultivates an internal locus of control in its managers. They know that the success or failure of their business rests on their shoulders. They have the authority to make decisions and the responsibility for the outcomes. This creates a powerful sense of ownership and accountability. A centralized, bureaucratic culture, on the other hand, fosters an external locus of control. A manager in such a system spends their time navigating corporate politics, writing endless reports for their superiors, and waiting for permission to act. When things go wrong, the natural human response is to blame the system, the bureaucracy, the idiots at corporate. Decentralization short-circuits this blame game. By giving managers both freedom and responsibility, Buffett creates a culture of high performers who are psychologically wired to solve problems and drive results. This is a core tenet of effective management assessment. How can an outside investor who doesn't have the luxury of sitting down with the company's managers spot the signs of a healthy, decentralized culture? You need a practical toolkit for observing the structure and behavior of the organization from afar. Let's call this mental model the trust test. It's a three-part framework for identifying the telltale signs of a culture that empowers its people versus one that stifles them in bureaucracy. First, you must analyze the corporate structure. This starts with a simple but revealing exercise. Investigate the company's headquarters. Is it a massive, opulent palace, teeming with thousands of corporate staffers, vice presidents of synergy, and layers upon layers of management? Or is it a lean, modest operation with a small, focused team? Berkshire Hathaway is the ultimate example of the latter. Its world headquarters, which oversees hundreds of billions of dollars in assets, famously has fewer than 30 employees. This is a powerful cultural signal. A lean headquarters indicates that the real work, the real decision-making, and the real value creation are happening out in the operating businesses, not in a central command center. You can research this by looking at company reports, news articles, and even satellite images of their corporate campus. A bloated headquarters is often a physical manifestation of a bloated, centralized, and inefficient culture. Second, listen for the language of the leaders. Pay close attention to interviews, conference presentations, and media appearances by the managers of the company's various divisions or subsidiaries. Do they speak with a sense of ownership and passion? Do they use words like "my business," "my team," "we decided"? This is the language of autonomy and responsibility. Or do they sound like corporate spokespeople, using cautious, vetted language and constantly referring to, quote, corporate mandates, strategic directives from headquarters, or the group's overall vision? The language they use is a window into their mindset. A manager who feels like a true owner talks like one. A manager who feels like a cog in a giant machine also talks like one. This qualitative analysis of language can reveal a great deal about the underlying power dynamics and culture of an organization. Third, investigate the speed of decision-making. One of the greatest advantages of a decentralized culture is speed. Autonomous business units can respond to market changes, launch new products, and solve customer problems far more quickly than a ponderous bureaucracy that requires multiple levels of approval for every minor decision. You can find evidence of this by searching for case studies, news articles, or industry reports about the company. How quickly did they respond to a competitor's new product? How long does it take them to bring a new idea from concept to market? Look for stories that highlight the company's agility and responsiveness. Conversely, a history of being late to market, of missing key industry trends, or of being bogged down in multi-year transformation projects is a classic symptom of a sclerotic, centralized bureaucracy. The trust test allows you to look past the official org chart and see the real, living culture of a company, a vital step in any thorough business analysis for entrepreneurs and investors alike. The antithesis of this empowering culture is the soul-crushing command and control bureaucracy. This is the path of the 99% of large corporations, organizations that become so obsessed with control, process, and predictability that they strangle the very innovation and human spirit that made them successful in the first place. The tragic story of the decline of Sears is a masterclass in the destructive power of a misguided top-down culture. In its prime, Sears was a titan of American retail, an innovative company that dominated the market. But by the 2000s, it was a struggling giant. In 2004, the hedge fund manager Eddie Lampert took control of the company, merging it with Kmart. Lampert was a brilliant financial analyst, a disciple of Warren Buffett, but he made a catastrophic error in his management of the company's culture. Lampert attempted to run Sears not as a cohesive retail operation, but as a portfolio of independent assets from his office in Greenwich, Connecticut. He broke the company up into more than 30 different business units, appliances, apparel, tools, e-commerce, and so on, and pitted them against each other. Each unit had its own president, its own board of directors, and its own profit and loss statement. The theory, borrowed from free market economics, was that this internal competition would drive efficiency and innovation. The reality was a corporate civil war. Instead of collaborating to serve the customer, the different divisions of Sears began to actively compete with each other. The appliance division had no incentive to promote the tools sold by the hardware division. The e-commerce team fought with the physical stores. Managers spent their time in endless meetings, fighting for capital and defending their turf, rather than focusing on the real competition, which was Walmart, Target, and a rapidly growing Amazon. This command and control structure, imposed from the top by a leader who rarely visited the stores, created a culture of fear, distrust, and paralysis. No one was focused on the overall customer experience because they were only being measured on the performance of their individual silo. The stores deteriorated, the brand lost its relevance, and the company entered a death spiral from which it would never recover. Lampert, the brilliant financial mind, had failed to understand a fundamental human truth, that great organizations are built on trust, collaboration, and a shared sense of purpose, not on rigid, top-down financial metrics and internal warfare. Sears is a heartbreaking example of how even a legendary brand can be destroyed when a culture of decentralized trust is replaced by one of centralized control and suspicion. The financial connection between a culture of decentralized autonomy and superior investment returns is both powerful and direct. It manifests in a company's financial statements through improved efficiency, faster growth, and better capital allocation, leading to significant long-term wealth creation for shareholders. First and most obviously, a decentralized culture leads to significantly lower overhead costs. A company that trusts its operating managers doesn't need a massive corporate headquarters filled with people whose job is to second-guess and oversee the people who are actually running the businesses. The lean headquarters of Berkshire Hathaway is the prime example. This structural efficiency means that a larger percentage of the company's revenue can be reinvested in its productive operations or flow down to the bottom line as profit. As an investor, you can spot this by looking at the SG&A line item as a percentage of revenue and comparing it to more centralized competitors. A consistently lower SG&A ratio is often the financial fingerprint of a culture that values autonomy over bureaucracy. Second, decentralized autonomy fosters innovation and agility, which translates directly into faster and more sustainable revenue growth. In a rapidly changing world, the companies that win are the ones that can adapt the quickest. A bureaucracy moves at the speed of its slowest committee. A decentralized organization can have dozens of business units, all experimenting, iterating, and responding to their specific market conditions simultaneously. This creates a much more resilient and adaptive enterprise. This agility allows the company to capture new market opportunities before its slower rivals even realize they exist. Over the long term, this capacity for rapid, localized innovation is a powerful engine for revenue growth, a key characteristic investors look for when finding growth stocks. Finally, a culture of trust and responsibility leads to better, more rational capital allocation. When a manager feels a true sense of ownership over their business, they are far more likely to be prudent and disciplined in how they invest its capital. They treat the company's money as if it were their own. This leads to higher return on investment for internal projects. Furthermore, in an acquisition-based model like Berkshire's, the success of decentralization can be seen in the treatment of goodwill on the balance sheet. Because Buffett buys great companies and lets their excellent managers continue to run them, the acquisitions tend to perform well, often exceeding expectations. This means Berkshire rarely, if ever, has to take the kind of massive goodwill impairments that plagued centralized, synergy-chasing conglomerates like AOL, Time Warner. The sustained value of the goodwill on Berkshire's balance sheet is a financial testament to the success of its decentralized, trust-based culture. It is the quantifiable proof that treating people like owners is not just good ethics, it is brilliant business. We have arrived at the fifth and final pillar, the very foundation of the financial temple that Buffett has built. This is the culture of frugality and rationality as a religious doctrine. This isn't about being cheap for the sake of being cheap. It is a deep, philosophical, and cultural commitment to the intelligent allocation of capital. It is the shared belief that shareholder money is sacred and that every dollar should be treated with the utmost respect and deployed with cold, hard rationality. Companies that embody this culture view waste not just as a business expense, but as a moral failing. To understand this fanatical devotion to financial discipline, we must look to the man Buffett himself has called the greatest business manager of his era, Tom Murphy of Capital Cities/ABC. Tom Murphy was the longtime CEO of Capital Cities Communications, a company he built from a single bankrupt television station in Albany, New York, into a media empire that included television and radio stations, newspapers, and the entire ABC network. Murphy was a legend, not for his charisma or his visionary pronouncements, but for his relentless, almost unbelievable focus on cost control and rational capital deployment. His frugality was not a gimmick, it was the central tenet of the culture he built. The stories of his thrift are legion. Corporate headquarters was famously Spartan, with second-hand furniture. He would review every manager's expense reports personally, questioning any extravagance. He was known to walk through the offices at night, turning off lights to save on the electricity bill. When Capital Cities acquired the much larger and more prestigious ABC network in 1985, the culture clash was immediate. The ABC executives were used to lavish perks, private dining rooms, limousines, and bloated departmental budgets. Murphy and his partner, Dan Burke, eliminated them all. The executive dining room was shut down, the limos were sold, budgets were slashed. But Murphy's genius was not just in cutting costs. He was a master capital allocator. He understood that the goal was not simply to be frugal, but to be rational. He would spend money when it was smart to do so, investing in news-gathering operations or acquiring new stations when the price was right. But he was ruthless about any expense that did not directly contribute to the long-term value of the business. He instilled this mindset in every manager throughout the organization. He gave them autonomy, but he held them to incredibly high standards of profitability. His famous management philosophy was to hire the best people, give them the resources they need, and then get the hell out of the way, but they had to deliver the financial results. This combination of decentralized operations and centralized financial discipline created one of the most efficient and profitable media companies in history. Buffett admired Murphy's culture so much that he helped finance the acquisition of ABC and became a major shareholder. He saw in Capital Cities a culture that mirrored his own deepest beliefs about business, a fanatical focus on efficiency, and an unwavering commitment to rational decision-making. Murphy's culture wasn't just about saving money. It was about creating a mindset where every employee, from the CEO down to the mailroom clerk, understood that they were stewards of the owner's capital. The culture of rationality that Tom Murphy built is a powerful organizational defense against some of the most destructive cognitive biases that afflict human decision-making, particularly the endowment effect and the sunk cost fallacy. The endowment effect, identified by behavioral economist Richard Thaler, describes our tendency to overvalue something simply because we own it. In a corporate setting, this bias leads executives to cling to underperforming legacy businesses. They become emotionally attached to a division because it's part of our history or because we've been in that business for 50 years, even when it's clear the business is a drag on the company's overall performance. They overvalue what they have and are unwilling to make the tough but rational decision to sell or shut it down. The sunk cost fallacy is a related and equally dangerous bias. It's our tendency to continue an endeavor once an investment of money, effort, or time has been made. We've all experienced this, sitting through a terrible movie because we've already paid for the ticket, or continuing to pour money into a failing project because we've already invested so much. In a corporate culture, this leads to what Buffett calls the institutional imperative, the mindless tendency of organizations to resist any change in their current direction. Managers will continue to fund a failing new product line or a disastrous acquisition not because it has a bright future, but because admitting it was a mistake would be professionally and psychologically painful. They throw good money after bad, trying to justify their past decisions. A culture of extreme rationality, like the one at capital cities, creates an environment where these biases are actively fought. It is a culture that depersonalizes business decisions. The question is not who will be proven right or wrong, but rather, what is the most rational thing to do with this capital right now, regardless of past decisions. It's a culture that rewards managers for making the tough, correct decision to shut down a failing project, rather than punishing them for the initial mistake. Tom Murphy's relentless focus on financial metrics was a way of enforcing this rationality. The numbers don't have emotions. They don't suffer from the endowment effect or the sunk cost fallacy. By making financial discipline the ultimate arbiter of decisions, he created a culture that was more logical, more adaptable, and ultimately, far more profitable. It is a culture that wages a constant war against the irrationality of human nature, a key to superior asset allocation and a winning investment strategy. To apply this final pillar to your own stock-picking process, you need a rigorous mental model for evaluating a company's cultural commitment to rational capital allocation. This is the most quantitative part of our cultural analysis. Let's call it the capital allocation checklist. It's a three-part test to determine if a company's management is a disciplined steward of shareholder capital or a reckless empire builder. First is the cash flow test. A company's statement of cash flows is one of the most honest documents it produces. It tells you exactly where the cash came from and where it went. Your job is to analyze the cash flow from investing and cash flow from financing sections over a 5 to 10-year period. Where does the company's free cash flow, the cash left over after maintaining the business, actually go? Is it consistently reinvested back into the business in the form of capital expenditures? If so, you must then ask if those reinvestments are generating high returns. Is it used to make acquisitions? If so, you must analyze whether those acquisitions were made at reasonable prices and if they actually added value. Is the cash returned to shareholders? If so, is it done intelligently? A rational management team buys back its own stock aggressively when the price is below intrinsic value and pays a steady dividend when it has a surplus of cash and limited high-return investment opportunities. A less rational team might squander cash on overpriced, ego-driven acquisitions or buy back shares at peak valuations just to prop up the stock price. The history of a company's cash flow decisions is a detailed diary of its capital allocation culture. Second is the debt discipline test. How a company uses debt is a powerful indicator of its financial prudence. Analyze the company's balance sheet and track its debt levels over a full economic cycle. Does management use debt prudently, perhaps to finance a high-return acquisition or to temporarily fund an attractive project? Or do they habitually pile on debt, loading up the balance sheet with risk? A culture of rationality is typically debt-averse. A leader like Tom Murphy or Warren Buffett understands that high levels of debt reduce a company's resilience and limit its flexibility. They want to be in a position to be greedy when others are fearful, and you can't do that if you're drowning in debt payments. Look for a strong balance sheet with a manageable level of debt relative to its earnings and cash flow. A history of reckless borrowing is a major red flag, signaling a culture that prioritizes short-term growth over long-term stability. Third is the say number test. One of the most important jobs of a CEO is to say no. They must say no to mediocre projects, no to overpriced acquisitions, no to departmental budget increases that don't have a clear return on investment. This is often invisible work. You won't find a line item in the annual report for dumb ideas we rejected, but you can find clues. Look for news articles or interviews where the CEO talks about deals they walked away from because the price was too high. Look for evidence of the company selling off or shutting down underperforming business units. These are signs of a disciplined culture that is not afraid to make tough choices. A great capital allocator says no far more often than they say yes. They have the patience to wait for the perfect pitch. A company that is constantly announcing new deals, new projects, and new expansions may appear dynamic, but it could also be a sign of a hyperactive, undisciplined culture that lacks the rationality to say no. This checklist provides a financial framework for assessing a company's deepest cultural values, a crucial final step in building a comprehensive, Buffett-style business analysis. The antithesis of this rational culture is the all-too-common growth-at-any-cost culture. This is the path of the 99% of companies that become so obsessed with top-line revenue growth that they lose all sight of profitability and long-term value creation. The most spectacular example of this cultural pathology was the dot-com bubble of the late 1990s. Companies like Webvan, Pets.com, and eToys became market darlings, achieving multi-billion-dollar valuations without ever having earned a single dollar of profit. The culture in Silicon Valley at that time was not about building sustainable businesses. It was about a mad dash for eyeballs, market share, and first-mover advantage. Webvan is a particularly tragic and instructive case. The company had a bold vision: to revolutionize the grocery business by allowing customers to order online and have their groceries delivered to their door within a 30-minute window. To achieve this, they built massive, state-of-the-art, highly automated warehouses, each costing over $30 million. They bought a fleet of expensive delivery vans. They hired thousands of employees. They spent lavishly on marketing. The company raised hundreds of millions of dollars from investors who were mesmerized by the growth story. The culture was one of unbridled optimism and a complete disregard for unit economics. The question was not, how do we make a profit on each grocery delivery, but rather, how quickly can we expand to the next city? The company was burning through cash at an astonishing rate. In the end, the business model was simply broken. The cost of the fancy warehouses, the delivery fleet, and the labor required to pick and pack the groceries far exceeded what customers were willing to pay. The company was losing a huge amount of money on every single order. But in the growth-at-any-cost culture of the dot-com era, this didn't seem to matter. The stock price kept going up. The company went public in 1999 and was briefly valued at over $1 billion. Less than 2 years later, it was bankrupt. It had burned through nearly $1 billion of investor capital. Webvan was a complete and utter failure of rational capital allocation. Its culture prioritized a glamorous vision over the boring, unsexy, but essential work of building a profitable business. It serves as a permanent monument to the dangers of a culture that chases growth at the expense of rationality. The direct financial connection between a culture of rational capital allocation and shareholder wealth is the most powerful and mathematically certain of all the pillars we've discussed. This is where culture translates directly into compounding returns, the engine of long-term portfolio growth. A culture of financial discipline is a machine for creating shareholder value. The most important metrics for identifying this are return on equity, ROE, and return on invested capital, ROIC. ROE measures how much profit a company generates for every dollar of shareholder equity. ROIC measures the return the company earns on all the capital it employs, both equity and debt. Companies with a culture of rational capital allocation consistently generate high and stable returns on the capital they deploy. They don't invest in projects or make acquisitions unless the expected return exceeds their cost of capital. This discipline ensures that every dollar the company retains is put to productive use, creating more value for the owners. As an investor, your job is to look at the long-term track record of these metrics. A company that has consistently generated an ROE and ROIC above 15% for a decade or more is almost certainly run by a management team with a culture of exceptional capital allocation. These are the compounding machines that can turn a modest investment into a fortune over time. Furthermore, a rational culture understands the true meaning of profit. It's not just about the accounting number at the bottom of the income statement. It's about generating real cash that can be used to create more value. This is why you must look at free cash flow per share. A company with a rational culture will show a long-term history of growing its free cash flow on a per-share basis. This is the ultimate test. It shows that the business is not just growing, but is becoming more valuable for its owners. This focus on per-share value is a hallmark of a shareholder-oriented culture. It ensures that growth is not just for the sake of getting bigger, but for the sake of making the owners wealthier. Ultimately, the financial result of a culture of frugality and rationality is a stock price that, over the long run, tracks the growth in the company's underlying intrinsic value. These are not the stocks that will be hyped on financial news networks. They are often boring, predictable businesses. But they are the ones that quietly and relentlessly compound capital year after year, decade after decade. By learning to identify the cultural DNA of a rational capital allocator, you move beyond speculation and into the realm of true investing. You align yourself with management teams who think like you do, who treat your investment with the respect it deserves, and who are dedicated to the same goal, the long-term compounding of wealth. This is the final and most powerful secret to spotting a billion-dollar culture. You have just navigated a deep and intricate framework, a journey into the hidden engine room of great businesses. You've gone beyond the superficial numbers on a page and learned to see what truly drives long-term value. The tool you have just acquired is incredibly powerful. You now possess a 5-part lens: the owner-operator mindset, the circle of competence, the moat mentality, decentralized autonomy, and rational frugality that allows you to analyze the very soul of a company. This is not just another stock tip. It is a permanent upgrade to your mental software as an investor, a powerful edge that the vast majority of market participants will never have. You have invested your time and attention, and in return, you have gained a framework that can protect and grow your capital for the rest of your life. But it is crucial to understand that what you have mastered today is one vital, foundational piece of a much larger and more interconnected system of thought. Warren Buffett's genius is not a single trick, it is a latticework of mental models that work together. Understanding a company's culture is the first and perhaps most important step, but to truly unlock its power, you must learn how to connect this qualitative analysis to the rigorous quantitative models of valuation. You must learn how to determine not just if a company is great, but if it is available at a price that provides a margin of safety. You need to understand how market psychology and the cycles of fear and greed create the rare opportunities to buy these billion-dollar cultures at a discount. The video that is now appearing on your screen is not an accident. It has been selected by an algorithm that understands your commitment to this deeper level of knowledge. Think of it as the next piece of the map, the missing link that connects the cultural analysis you've just mastered to the financial discipline required to turn that knowledge into wealth. The journey of a serious investor is one of continuous learning, of constantly adding new tools to your mental arsenal. The choice to click is not about watching another video. It is a decision about your identity. It is a choice to continue your ascent, to build upon the powerful foundation you have just laid, and to complete the intellectual framework necessary to achieve true and lasting financial success. The next piece of the puzzle awaits. Continue the journey.